What you're seeing right now is a live liquidity position on the brand new Robinhood blockchain. And this position has been paying cash every single day since Thursday. So I opened this up on Thursday, the 23rd, about $8,500 into the position. And then every day or two, I've just been collecting the fees, about $56 on Friday, $46 or so on Sunday. So I took the day off on Saturday, $34 yesterday, and about $44.13 earlier today. So now, if you want to earn daily cash flow like this from your crypto without having to sell, you're in the right place. Excuse me. And it's it's kind of a silly question, of course. If I asked 100 different crypto investors whether or not they'd like to earn daily cash from their crypto assets without having to sell, of course, I'm going to get 100 yeses. No matter who you are, we all need income. We all appreciate daily cash flow. So, of course, it's kind of a universal thing. So, the question is, why is almost no one actually doing this? Practically no one does this. So, why is that? Well, the first reason is the learning curve. And I say this all the time. Um, you know, what we do in DeFi, it's not rocket science, but it's definitely not trivial. Okay. There is a learning curve that goes into this. And thankfully, one of the things we offer, you can see a link for this in the description below. I also pinned the link in the chat. So if you're in the chat right now, you can see the link for this. This is our free mini course. So it's only 5 videos. It's less than 45 minutes. You can watch through those videos and learn how to do what we're doing. Now, if that's not enough for you and you need more help and more support, then you can join our overseas DeFi community. And when you join, you do get our portfolio tracker app. So you're able to connect your wallets to the app. And then you can see all of your different DeFi positions in one place. We're also very proud of our overseas DeFi AI chatbot. So the AI agent lives in that portfolio tracker. So one of the things about our AI is it can see all of your positions, your lending, your borrowing, your spot assets, even your perps positions and your liquidity positions. It can see everything. And the AI is its brain is completely trained on all of our different strategies, all of our workflows. It's been trained on every single different workshop and Zoom call and open office hours, even the YouTube videos that we make on this channel. Everything gets packed into that AI's brain. So it really is helpful in helping you and guiding you through the different aspects of setting up a DeFi portfolio. And of course, we have a full video course inside of the app and quite a bit of support within the app as well. So one of the things we do for our overseas DeFi community is we have a weekly Zoom call. So you can share your screen and get real-time Q&A and real-time support within the overseas DeFi community. So that's the first reason. The second reason why people tend to avoid doing this and earning that daily cash flow from their crypto assets without having to sell is it's a very real and an important fear. And that's something called impermanent loss. So if you've ever done any research into providing liquidity, no doubt at some point in your research, you discovered this thing called impermanent loss. And you probably it probably didn't make a lot of sense, or it's kind of confusing, but it is right to be afraid of this. So we're going to talk about this. And one thing that's important to understand, excuse me, one thing that's important to understand about impermanent loss is it goes both ways. So what does that mean? So when you provide liquidity on a decentralized exchange, if the price goes up, you actually make a profit. And that makes sense. You put your money into a liquidity position. If price goes up, you make money off of that. Plus, you earn the fees as long as the price stays within your range. The catch is you don't make as much money. You don't make as much profit in a liquidity position as you would just by holding the spot assets. Okay. So it's not really a loss per se. It's more of an opportunity cost. You're giving up a little bit of your upside potential by putting capital into a liquidity position rather than just putting it into spot assets, just buying the coins and holding on while the price goes up. But nobody really worries about this, right? If you put money into a liquidity position and the price goes up, happy days. It's great. You're getting a little bit of profit as the price goes up, and you're earning the fees. All is well. So nobody is too concerned with the upside of impermanent loss, although technically that is part of it. So impermanent loss goes both ways. This one, we're not going to really worry about this tonight. What most people worry about and what most people are afraid of is when the price goes down, right? And if you've paid any attention to the crypto markets over the last nine or 10 months at this point, it's been doing a lot of that price going down. And this is the one that actually costs you money. So as the price goes down, you're still earning the fees. As long as the price is inside of your price range for your LP, you're earning the fees. But as the price goes down, the value of your overall liquidity position, that's going down. And it can go down more than the fees that you're making. So it ends up being, it costs you money, right? So this is the one that we're going to talk about tonight. And tonight I'm specifically going to show you a strategy that will enable you to completely eliminate the downside risk. Now, again, I said downside. We're not talking about upside risk. That is still present. There's no such thing as a free lunch. But if you're interested in protecting yourself for that downside risk, which is a very real risk in our markets these days, this is what this strategy is going to help you with tonight, is eliminating that downside risk. So specifically, what am I talking about? As the price falls, okay, your liquidity position loses value. And that's kind of obvious. That's straightforward. If the prices are coming down, of course, your liquidity position is in that market and the value of that position is dropping. And so the strategy that I'm going to show you tonight is a way to offset that loss with a short position. Now, this is a trade. Okay, and the strategy I'm going to show you tonight, it requires a trade on a perpetual futures exchange. I'm going to demonstrate how to do that. I'm going to show you the GMX decentralized exchange. Okay, so with this trade, this is a short trade. Normally, when you think about trading and investing, you're only thinking about long positions. So a long position is when you profit as the price goes up. So that's very straightforward. We've all heard of that. Maybe we've dabbled in the stock market or whatever. You buy something, and if and when the price goes up, happy days. You've got a profit, right? A short position is the opposite. Okay, so this is a type of trade where you actually make profit when the price goes down. So it's completely the opposite from a long. Short makes money on the way down. And if you set this up properly, which again, I'm going to show you the complete strategy tonight on the stream. Side note, if you have any questions as I go through this, do not hesitate to ask me a question in the live chat. Just pop it in there and it'll come up here on my screen and I'll be able to take your questions. I'm happy to take questions. So when we have this set up properly, for every dollar of value that's being lost on the LP, we're making a dollar of profit on the short position. So these two parts of the position completely offset each other, and you end up with zero loss. Again, in the case of the price falling. Okay. And bonus, if you're not making any money, not losing any money, even if the price is going down, you're staying at break even on your value, you still get the fees, right? So as long as the price is inside of your range, you're earning the fees. And so that at that point, it's basically free money. You have no downside risk. The price can tank and you don't lose a single dollar, but you do collect the fees even on the way down. Again, as long as the price is inside of your range. So again, no such thing as a free lunch here, and there is a cost to this, to setting up. That looks like it's better. Hopefully you can see my slide deck now. Let me see. It seems like my camera feed is gone. So let's go to the full screen mode. Okay. Thank you, Daniela. All right. So we offset the losses with the profits on the short position, and we keep collecting fees the whole time. There is a cost to this. And so the thing with a short position is you make profit when the price goes down, but if the price goes higher, the short position is actually losing money. And so we can talk about that, but basically, in a nutshell, the way I deal with that is the size of my short position is it's significantly smaller than the spot assets that I'm holding outside. So if you look at this, if you just look at the liquidity position plus the short position, these two are going to be the same size. But outside of this, when you look at my whole portfolio, I have lots of spot assets where if the price keeps going up and up and up and up, I'm making tons of profit on my spot holdings, even though I would be losing some money on the short position. And the LP, by the way, if the price really goes high, then the LP just converts to stable coins. So that just doesn't gain or lose any value once it's been converted to stable coins. But that's definitely one of the things we're going to be talking about tonight. Well, let me get to that slide in a second. So if the price runs higher, the short position does lose money. And this is the trade-off we're making with this. Okay, we're trading that upside loss in order to get that safety net. And that's what we're talking about tonight. This is like installing a safety net underneath your liquidity position. So you're earning cash flow from your LP every day, but you can sleep easy at night because you have that safety net. If there's a big crash and the price just drops to the floor, you don't have to worry about your LP because the short position is going to offset those losses. So it's exactly like having a safety net underneath you. You're walking along, you're collecting the daily cash flow, but if price falls, that net is going to catch you. That's what the short position does. And of course, we're going to go into detail on setting up the short position. We'll talk about the funding rates, we'll talk about liquidation, and we'll talk about this is a pair, right? So you have your LP, your liquidity position, and that has a designated range for your liquidity. So we'll talk about the price range of your LP and kind of the idea of where you want to short and where you want to possibly cover the short or take profits on the short if you're feeling confident that the price is going to be range bound. So we'll talk about all of that. And this is exactly what we're going to go through tonight. So number one, before we can talk about any of this, we have to understand what impermanent loss actually is. And so the key to that is just understanding exactly what happens to your capital when you put your tokens into a liquidity pool. Okay, so what happens when the price goes up? What about when the price goes down? And we'll look at the actual chart. I'll show you my liquidity position in terms of the actual range that I'm running on this Robinhood position. And we'll go through exactly what happens to your capital. Okay. And then we'll talk about the worst case scenario. So again, the idea is to protect against a massive price drop. So what is the worst case scenario? If the price drops down to the bottom of your range, which we're going to learn right here, your position becomes converted into the volatile token. So typically we're providing liquidity for a pair that consists of a volatile token like ETH and a stable coin. If the price goes to the bottom of your range, you get fully converted into ETH. And that's what decides and dictates how big of a short position you need to have in order to offset the losses at that point. Because again, we're trying to protect ourselves if the price drops and keeps dropping. That's the idea. So we need to decide exactly how big that short position needs to be to offer that protection. And then I will demonstrate and show you click by click on GMX exactly how you can set up one of these positions. You can go long, or we're going to be going short. You can use a market or a limit order. I'll talk about the margin, the funding rate, and how liquidation works. Like when the price moves against you, it eats into your margin. What even is margin? So we'll talk about all of that tonight. Okay, so let's start out by looking at the chart. Now, you guys know me. I like to represent my liquidity positions and my ranges with these little rectangles on the chart. This is a 1 hour chart. So what we're seeing is each and every one of these candles represents 1 hour of trading. So I started this position here on Thursday, the 23rd, and that's my range. The bottom of my range is about 1842, with the top of the range being 1962. If we finish out this, I'd be happy to talk about some technical analysis and kind of what I've been doing with my range. You can see I've been moving it up the chart. We've been in an uptrend. So that's what I've been doing with my range, and we can talk more about that. But what I wanted to talk to you about is what happens to your tokens when you put it into one of these liquidity positions. So the easiest way to understand a liquidity position is your money is trading against the traders. Hey, Maria, glad you're here. Nice to see you. So if traders are trading between, in this case, ETH and USDC, it's my tokens that are being traded, right? And so an easier way to understand that from what I just said is if a trader connects their wallet to the exchange and they buy ETH, guess who is selling ETH to that trader? It's me. It's me and all the other liquidity providers. So if traders are buying Ether, the liquidity providers, including me, are selling Ether to the traders. On the other hand, if traders are selling ETH, it's the liquidity pool, and all of us liquidity providers, we're the ones that are buying ETH from the traders. Now, think about that from the perspective of a chart like this, a price chart. When the price is going down, it means that most people are selling. That's why the price goes down, because people are selling more than they're buying. And then when the price goes up, it's because traders are buying, mostly buying, not so much selling. So it goes down, traders are selling, and then it went sideways, and then it went up. Traders are buying and buying and buying all the way up. 1 second. My dog is as usual, deciding this exact moment to cough up a lung. Okay, he's quiet. Pretty old dude, my dog. Okay, so when you think about providing liquidity on an exchange, think about what your capital needs to do compared to what the traders are doing and compared to what the price is doing. So I'm going to zoom in, and we can see that when I opened up this position, the price was pretty much right in the middle. And so what that means is that I had to deposit tokens into both portions of this liquidity position. Okay. Now, remember, if the price is going down, it means that traders are selling ETH. And so as the price moves down in this portion of my range, I need to have a supply of USDC. Why? Because it's the USDC that I'm spending to buy ETH from the traders. Okay. So when I load this position or deposit my tokens into this position, I put USDC in this portion, and then I put Ether in this portion. Okay. So I load it up. I think you can think of this as two shelves in a very simple store. If you have opened up a little store and you have two shelves, you sell two things in that store. You sell ETH and you sell USDC. So if traders come in and they're buying ETH today, they're taking ETH off of your ETH shelf and they're giving you USDC. If traders are selling ETH that day, they're putting ETH onto your ETH shelf and they're taking USDC off of your USDC shelf. Okay. So this is how you load up the position. And this is how you think about what happens to your position as the price moves up and down inside of your range. So as the price is going down, like when I opened it, it was about 50-50. So I had about 82, about $4,200 worth of ETH and about $4,200 of USDC. But then later on, like when the price was all the way down here, the balance of my liquidity position automatically changed. So as the price came down, I kept buying more and more ETH from the traders, right? So my ETH shelf has stacked up a lot higher, and my USDC shelf has dwindled. Okay. So the position, now, by the way, you don't have to do anything. All of this is handled by a smart contract. Okay. So it's set it and forget it. But it is important to understand how the balance of your position changes as the price goes up and the price goes down. Now, of course, the value changes as well. So I bought all of this ETH here, and I paid probably around $1,900 for that ETH. But then the price dropped down to here. So that $1,900 or that ETH that I bought at a higher price, it now has a lower value when the price went down, correct? I have more ETH because I've been buying more of it at lower and lower prices all the way down, and I have less USDC. So the balance is more ETH, less USDC now, and the dollar value of each ETH token has come down. Okay. So as the price drops, the balance is changing and the value is changing, right? In this case, the price is going down. So the dollar value of my liquidity position is going down as well. All right. And that's exactly what we're going to protect with the short position. Okay. Now, what is the worst case? And this has been an interesting chart because it kind of bottomed out here at the trend line that I've been watching. Let me delete all of these extra drawings. I don't really want those anymore. I'm not sure why it's not showing up in my drawings here. I guess I'll have to delete it the old-fashioned way, just one at a time. Usually it shows up in the object tree here, but for some reason, TradingView is being weird. Okay. So yeah, as the price went down, it almost got to the bottom of my range here. And then over the last few days, we've been having a rally, and then we had another sell-off. And now we're kind of bouncing higher, almost right back where we started. So at this point, now we can look at the logs on Revert. You can see I started this position with $8,562. And at the moment, it's about, what, $35 higher. Well, why is it higher? Why is the value of my position higher? Well, that's because the price of ETH has come up. Remember, I bought the ETH here at about 1900. Now I bought more ETH here. The position bought more ETH, but then as the price is going up, the opposite happens, right? If the price is going up, it means that traders are now buying. So if traders are buying, what's my position doing? It is selling ETH to the traders. So all the ETH that I bought on the way down, it all just gets sold right back. And so as soon as the price returns to that initial level, my value is going to be the same. That's why it's called impermanent, because it's a dynamic situation. The price is constantly moving. And so when the price was down here, the value of my position had, it was depreciated. It was lower. But then as the price came back up, that impermanent loss went away. And now I had the same amount of value. Okay. As it's gone higher, I'm actually getting a profit, right? The ETH that I bought, it keeps getting sold off, right? As traders are buying the price of ETH higher, if they're buying ETH, my position is selling ETH. And so I keep selling a little bit of ETH every step of the way. But the ETH that I still have is at a higher price now. And by the way, each time the price goes higher, now I'm selling it for a higher and higher price. So you will have a profit as the price goes from your starting price to the upper part of your range. It's just that the profit is not as much as if you just bought ETH at 1900 and then just rode it up to whatever this was, 1970. Also, what happens, as you see right here, the price actually escaped. So it went above the top of my range. And at that point, as soon as the price touches the top of my range, my position has run out of ETH, right? So traders are buying, buying, buying. My position is selling, selling, selling until the shelf runs bare, right? As soon as the price hits the top of my range, there is no more ETH in my position. My position is fully converted to USDC. Okay, so that's the case when price escapes the top. Now, what if price escapes the bottom? So if it comes down here and it goes all the way down to the bottom of my range, as soon as it hits that lower limit, now I'm out of USDC, right? My position kept buying ETH from the traders all the way down until the very bottom, at which point I've run out of USDC. I've bought all the ETH that I could possibly buy, and now I don't have any more USDC. In other words, my position is now 100% ETH. So that's the worst case scenario. And I'll try this again. although TradingView doesn't seem to want to cooperate. If, let's say, the price drops all the way down here, okay, at this point, I'm all out of USDC. At that point, it's pure ETH, 100% ETH. And that ETH has a price. And if the price keeps going down, I'm continuing to lose value on that position. Now, if I don't do anything, even this is still technically an impermanent loss. It's a temporary or paper loss, because if the price bounces, well, as soon as it crosses the Rubicon here and starts entering my range again, well, now I'm starting to sell the ETH back to the traders, and my position is slowly accumulating USDC back. The price keeps going higher, and at this point, my entry price, I would be right back to break even. I'd have the exact same value. So it is impermanent. All right. But what we're talking about today is the worst case scenario and sizing your short position to protect your downside, right? That's what it's all about, protecting or eliminating your downside risk. Okay. So regardless of what the price actually does, what we're talking about is the case where the price drops, it escapes the bottom of your range, and it keeps on going. Okay, that's the nightmare scenario. If you don't have protection, if you don't have that safety net, it just keeps falling and falling. You're bleeding value every time it goes down more. Okay, so that's the scenario. And once again, there we are. I don't know why it didn't do that last time, but this is much easier to just click on those deletes. There we go. Okay. So hopefully that is clear. Again, don't hesitate to interrupt me and ask any questions that you have in the live chat. This is a live stream, and thank you all for tuning in to the actual live stream. If you're watching the recorded version of this later on, I really appreciate it. Make sure to like the video, leave a comment below, subscribe, and most importantly, turn on the notifications, right? So if you're watching the recorded version, you missed the live stream. You missed the opportunity to ask me direct questions in real time. So turn on those notifications, and that way you'll get notified every time I go live, and you'll be able to tune in and ask your questions. I try to do this. I'm not perfect, but I do try to do this every week on Tuesday at 6 p.m. Eastern. Okay, so let's talk about that worst case scenario. Now, to figure this out, you could do the rough math, right? So if I look at my position right now, I could calculate my worst case scenario. So right now I have there's about $8,600 in there, 8,600. And what I want to figure out is, what's the value? How many ETH is my position going to have if the price drops? So if the price crashes, we just discussed, if the price crashes, my entire position gets converted into 100% ETH. And so then the question is, how many ETH will I have? How many wrapped ETH tokens will I have down there at the bottom? And so I could do the rough math. I could take $8,600 and then divide that by my lower limit. So if the price goes all the way down to 1842, that's going to be about 4.6 ETH inside the position. Now, it's not accurate. It's not super accurate, because my position doesn't buy all the ETH right down here. It buys a little bit here, and then some more, and then some more. It buys ETH all the way down from the current price down to the lower limit. But that's the rough math. If you want to do it the easy way, you can just do that. Take your position size, divide by the lower limit, and that's going to tell you roughly how many ETH would be in your liquidity position if the price crashes. All right. So it's your worst case scenario. Now I'm going to be a little bit more technically accurate. I'm going to use this website called Krystal. I've already brought up the hot pools tab and I've filtered it for wrapped ETH USDC. I'm going to click into this position right here. And I'm going to simulate the impermanent loss. So Krystal has, oh great, it's going to not work for me. Awesome. So I might not be able to demonstrate the impermanent loss simulator that they have on Krystal. I've refreshed the tab. Let's see if this works. Don't you just love proving that you're human all the time? I just love it. Here we go. So in order to simulate my actual liquidity position, my range is 1842.40. So I'll just put my range in here. 1842.40. Top of my range is 1962.60. 1962.60. So that's the first step. You just put in your range, and at the moment my position is 85.98. So I'll put that in here. So liquidity $8,598. So this is telling me the current balance. There's the ETH that's in the position and the USDC that's in the position right now. I'm going to click on this IL simulation. So this is the simulator that's going to show us the impermanent loss. So you click into that, and then what you want to do is dial in a future price somewhere below your range. So 1842 or lower is going to tell us what happens to the position. So like I said, as the price goes down, all of the USDC goes away. Price is going down. Your position is buying ETH from the traders. It is exhausting all of its USDC supply or inventory until it gets down to the bottom of the range. All of that USDC is now gone, and you're left with 4.54 ETH. So this would be a much more precise number in terms of what is your worst case scenario. If the price crashes, how many ETH are you going to have to protect? Because now it's ETH, and if the price keeps going down, you're losing value to the tune of 4.5 ETH. So now we get into GMX, and this is the number that I used to set up my short position so that it would be correctly sized. And again, the idea is I'm going to size my short so that I make $1 for every dollar that I lose on this 4.5 ETH. So let's go to GMX. And I do need to change my wallet. So I have my GMX position in a different wallet. So let me change that. And so now it's connected to my wallet. You can see the balance of my USDC in my wallet. This is the Arbitrum blockchain. So even though my liquidity position is on Robinhood chain, my short position is actually on the Arbitrum blockchain. Let me switch over. I also have a long position on Sui, right now. But what I want to show you guys is the short position. Okay. There we go. Okay. So I opened this short position yesterday. Yeah. Yesterday. And you can see my entry price right there is about 1,945. Why did I choose that entry position? Because that is a fairly high price. So I did a little bit of basic technical analysis, nothing crazy. Okay. Not 15 different indicators on my chart. This is just basic price action technical analysis. And what I noticed is there were a lot of highs in this area. Now, this is a bit of an exception, and the price did go higher, but you can see there was a high right there. There was a high right there, even right there as well. So every time the price comes up to this 1945 level, it has a tendency of reversing and going back down. So this, I would call this a pivot point. The price tends to pivot at this 1945 level. Now, when you're trading a short position, the idea is you enter the position when the price is high, and then you close the position when the price is low. That's how you can get a profit. So I technically I could open up the short position at any point, right? But I just decided to be a little bit more strategic with it. You can actually see I was actually long. So I had a long position on GMX, took a little heat, and then closed that out for profits. And where did I close it? Where did I close my long trade? I bought down here because of the trend line, and I closed that right here at 1945. Again, 1945 is a very clear area of resistance. Okay. So that was a profitable trade to the long side, benefiting when the price went higher. And then the short position is you sell first. You short the market first, and then the idea is you buy back at a lower price. Okay. So when I set up this, or when I entered this short position, I wanted to do it at a price that I believed was high. And there's no certainty with markets. You never know what's going to happen, and you never know what the price is going to do. All you can do is play the probabilities and try to make the best decisions when you're analyzing the price action and you're looking at all your different technical analysis. Even if you do like all those different indicators, I'm not a huge fan. You try to determine where you think the best probabilities of the price doing what you think it's going to do, where those are. So I chose 1945, and sure enough, it went down. Now, if I close this short position at any price lower than 1945, that's going to be a profit. But I'm not really looking to trade this. This is more of my insurance policy. This short position is my safety net, right? So if price just crashes, tomorrow we have FOMC. There's a non-zero chance that the Federal Reserve will raise interest rates tomorrow. I don't expect it to happen, but it's not impossible. And so if they do, I want that downside protection. If the Fed raises rates tomorrow, we're probably going to have a pretty bad red day in the markets, including ETH and Bitcoin and all of that. So I want to have this downside protection in place just in case the price crashes and it keeps on going. So I'm not really looking to close this trade out necessarily. It's more of I have this short position in place as protection. So how do I do that? So first of all, I connected my wallet. This is a decentralized application, or a dApp. It works on EVM. So you just use your Rabi wallet and you connect your wallet to the protocol. Now for me, I have USDC in my Arbitrum wallet. Okay, I do have some assets on the base. Actually, most of my assets in this wallet are on the base blockchain. Let's just pop this up here. Everything is like 3 times slower than normal. I apologize for that, guys. So I have some assets on the base blockchain, and I have some USDC and other assets on the Arbitrum blockchain. So for my preference, I put USDC into my Arbitrum account in Rabby and connect my wallet, and then you can see my available USDC in my wallet right there. Okay, now, first things first, the leverage. You can see I have this set to 10x. If you're just starting out with this, please don't use 10x leverage. Certainly don't use 50 or 100x leverage. Be conservative, especially if it's your first time. You can use 2x or maybe 3x. Let's use 2x because it'll make the numbers so much easier. So that's the leverage. You just click into that. You set whatever leverage you want. You could type it in there and then just close that out. So that's the first part. The second part is deciding whether you want to go long or go short. So if you go long, it means you're going to profit when the price goes up. If you go short, it means you're going to profit if the price goes down. Okay, so that's what we want to do for this exercise is we're going to choose short. Now, the next part right here is you got to choose your order type. Most of the time, you're going to either use a market order or a limit order. So market order means just open the trade now. Whatever the price is right now, that's where I want to enter this trade. So if I went short right now, it would get me short, and my position would have an entry price of about 1911 or 1912. Okay, so that's the current price. Market order, a market order is just instantly executed, and it gets you into the trade at the current price. A limit order is for being more selective and being more patient and for letting the market come to you. So for example, if I wanted to add to this position, I can just type in 1,945. Now, if I place this order, it's going to sit up here. If the price never goes up there, the order doesn't get filled. I don't get into the trade. But if the price does go up to 1945, it's going to fill my order, and then my entry price will be up there at 1945. Okay, so that's the difference between a market and a limit order. Stop me and ask a question in the chat if any of that is confusing. Now, the margin. Think of this literally, you can think of this as walking up to like a blackjack table in Las Vegas. And what's the first thing you do? You walk up to the table, you grab a seat, you put money on the table. Margin is the money you're putting on the table. Okay. This is the money that you're putting at risk in futures. Okay. In a perpetual futures exchange like this. So you place, in this case, I'm placing 1,000 USDC at risk. Again, think of it as putting $1,000 of chips on a blackjack table in Las Vegas. What's the most I can lose? 1,000 USDC. Okay. So I put my margin amount right there. And so this is your decision point as to how much money are you willing to risk on this trade. Now, because I've entered 2x leverage, this money I've put on the table is amplified by 2 times. Now, it's a little bit less than 2,000 because there's a fee associated with GMX and doing this exchange. Okay, so but roughly, for all intents and purposes, we've doubled the size of our bet. Okay, so I put $1,000 at risk, and the size of my bet is $2,000. So I've amplified. Now that amplification works both ways. If the price moves my way, If I'm betting short, I want the price to move down. So if the price moves down, I'm making profit. But if the price moves against me, then I'm losing money. And if I doubled my exposure, I've doubled my profit and I've doubled my loss, depending on where the price goes. Okay. Now, if let's do this as a market order. And so what you can see is I've provided $1,000. I've doubled the size based on the leverage factor, and that's going to equate to roughly 1 ETH. Why is that? Because the price of ETH right now is 1907, and the size of my position is 1997, right? So let's do the math. So 1997 divided by the current price, 1907.35. That's why it is 1.047 ETH. So by setting up this position, I am controlling approximately 1 ETH. I couldn't do that with the leverage. With $1,000, I can't control a whole ETH. I can only control a little bit more than half of an ETH at this current price, right? Because of the leverage, I get to control a little bit more than 1 ETH. So what does that mean? So if my trade is the equivalent of 1.04 ETH, that means if the price goes down $100, I'm going to make $104, right? If the price goes up $100, I'm going to lose $104, right? So if you owned 1 ETH and the price went up $100, you just made $100. If you're shorting 1 ETH and the price goes up $100, you actually just lost $100, right? So that's how you do the math on your profit and your loss. Now, unlike a bet at the casino, you bet on one hand of blackjack. When that hand is dealt, the bet is done. I mean, you can bet on the next hand, but it's a single bet and it has an outcome. A futures trade is ongoing. You can keep this position open for as long as you want, as long as you don't run out of chips. So that's the last thing I'm going to talk about is the liquidation, right? So if I risk 1,000 USDC, now I'm controlling about 1 ETH. And so that means, and I'm betting short. So if the price goes up, I lose money. If the price goes up $1, I lose $1.04.8. If the price goes up $2, I lose $2.10. All right. I only have $1,000 to lose. So this is not allowed to go up indefinitely. There's a cap on how much money I can lose. There's a cap on how much the price can go against me. Now, roughly speaking, if I take my $1,000 and I divide by the 1.0477 dollars that I lose for every dollar of price movement, I can only afford the price to move $954. So if we look at my entry price and then we add that $954, that's how it comes up with the liquidation price. Now there's some fees and other things that factor in, but the price right now is about 1,900. And if the price goes up by roughly $500, that's where I'm going to get liquidated. And I think this is actually wrong because it's already factoring in the position that I already have. So that's screwing it up. But if you because it's already looking at the fact that I already have this short position open. But that's how you think about the liquidation, is you have a limited supply of chips sitting on the table. With this position that I've talked about here, it's controlling 1 ETH. So if the price goes against me, if the price goes up, I'm losing $1.04 for every time the price goes up another dollar. So it's a limited movement. The price can only go up so much before I end up running out of chips. I only put 1,000 USDC chips on the table. If that stack runs out, the position is going to get closed out. So that's called a liquidation. Okay. And I said that was the last thing, but I forgot to cover the funding rates. So these on GMX, it shows you the funding rates for a long position. That's the little green arrow. I don't know if you guys can see that. There's a little green up arrow. So this indicates the funding rate for a long position. And this little red down arrow is the funding rate for a short position. It does have an explanation there if I leave my mouse in the right spot. So long positions, the net rate is minus 9.45% per year. That's what you have to pay in order to trade to the long side, at least right now. Short positions net rate is minus 2.88%. So right now, it's cheaper to go short than it is to go long. So the funding rate, usually it's going to be positive on one side of the trade and negative on the other. So in other words, see right now, if you look at the open interest, there are $9 million in short positions right now and only $5.4 million in long positions. So a lot of traders are going short right now versus going long. And so it's a little bit imbalanced from, I would say, the normal. And usually what you're going to find is the funding rate for shorts is actually positive. Let me see if I've earned some cash. Yeah, see, I've had this position open only for a day, but I've earned $2.13 in positive funding fees. Now I could settle those and then take them over here and claim them out. I'm just going to leave them be. But most of the time for a short position, you're actually going to have a positive funding rate over here, which means you actually get paid to hold this position. I've never done this GMX stuff. I will have to try it. Is it only EVM chains? No, Maria, you can actually do this on the Solana blockchain as well. So I'm just using EVM because just for convenience, and I like having my position in my Rabby wallet. It'll show up in our app as well. But no, you can also trade on Solana, or you can sign up for a centralized exchange, like there's one called Blowfin. They're geo-fenced, so us people in the US generally will have a hard time using those futures exchanges, the centralized exchanges. But GMX is a decentralized exchange and doesn't seem to have any issues with me being in the US. Yeah, so I use it on Arbitrum. You can use it on Solana as well. So I think that about covers it. Oh, that must be that must be my buddy Roman. But yeah, so no, actually, you can use GMX on Solana as well. You can actually connect your base wallet as well. So if I wanted to fund my GMX with USDC on base, I can do that. I like using Arbitrum though because it's interactive, and I can actually see all of the trades on the Arbitrum blockchain, as opposed to if you do it on base, all the trades are like internal, so you end up having to it's a little bit more complicated when you're doing the accounting. I use Coinly for all of my crypto accounting. And so I prefer to use Arbitrum on this. But yeah, I think I covered everything. Funding rate, talked about how your margin gets consumed as the price goes against you. Now, again, it works both ways. If this price, I'm betting short, and if the price goes down, now I'm actually making profit. And you can see my current position, the short position on ETH, my entry price was 1945. Hopefully you guys can see that. And the price is lower. So the price has dropped approximately, what is it, about $42. Now this position is bigger than 1,000. I put 2,500 on this, and I used 4x leverage. So if I click on that, and that was the sizing that I forgot to mention. So I showed you the worst case scenario where we looked at the simulation on Krystal, and we saw that if the price tanks down, I'm going to have about 4.5 ETH. So then if you look at the size of my short position, it's a little bit more. So it's a little bit larger, but that's fine. So that just means I'm a little bit overly hedged, not a ton. About 4.7 is the equivalent number of ETH that I'm short, meaning every time the price goes down $100, I'm going to make $472 of profit on this. This is nice. Some questions. I love it. So for your 8.5K investment, how much is that generating per day on average if it stays within your range? So caveat on this. Great question. Thank you for asking it. This liquidity position that I'm running, this is on a brand new blockchain. This is on the Robinhood chain. And Robinhood chain has been crushing it lately. There's a ton of volume because this blockchain is associated with, millions and millions of users on Robinhood. So there's been a ton of volume, and the fees that I've been seeing on this position, you can see the fee APR right there. And again, if we open up the logs, these are real. This is a real live position. I can click on, any one of these transactions. You can see the actual transaction receipt if it ever loads. Everything is super slow tonight, but this is a real live transaction on the Robinhood blockchain. There's all the details. If it ever loads up, the hash, the wallet, the fees that I received, and everything else. So these are real live fees that I've collected. You can see my deposit. And Revert is nice because it does the math for me. So this has been open a little bit longer than 5 days. And I think the total fees is something like $180. $180 off of $8,500 in 5 days. So it's about $180 that I collected in 5 days. And then how many 5 days in a month? Times 6, that would tell you roughly what I could earn in a month. So then if we take that $1,000 and divide it by my $8,500 position, it's I didn't do that right. Let's try that again. So it was $1,080 divided by $8,500. There we go. So it's about 12.7% per month. Now, again, the caveat here, this is unusually high. The volume is high on Robinhood chain right now. It was even higher when I first started. I actually started my position on July 14th, and the yields were even higher at that point. And it's come down. So, but it's still pretty elevated. So 12.7% a month is obviously phenomenal. I do not expect that to last long term. But you can see it's been doing pretty well. And the other thing here is that on the 26th, that was actually a Sunday. Um, and you notice, like, so the first day I made $56, but the weekend, Saturday and Sunday, I only made $46. Right. So this is 2 days, and that's because the volume drops off on the weekends. And then it picked back up a little bit on Monday, and then today was great. $44, basically $44 in a day. I think the average here is about 30 something, $36 a day or something like that. So yeah, this is obviously quite high. And like Roman said here, more typical is somewhere around 5, 6, maybe 7 or 8% per month. So something like 60 to maybe 100% APR on these liquidity positions. So it's phenomenal. Much better than anywhere in TradFi, right? And then Maria had one question too, and I do not use a stop order. But this is a great question. I'm glad you asked it, because I did talk about the upside, right? This short position that I have right now, this protects me if the price drops. But if the price goes up, I'm actually going to be losing money on this position. And this position, like we just discussed, is about 4.7 ETH. So if the price goes up another $100, I just lost another $472. And then if it keeps going, I keep losing. Right. So the question would be, well, should I put a stop loss order on that? A stop loss on a short position, you'd put a stop loss above, right, to stop yourself out of the position if the price goes too high. In my case, I would just leave it. So first of all, I'm fairly confident. If I zoom out here a little bit, let me turn off some of these extra drawings. Let's turn off my ranges as well. I am tracking a couple of different resistance levels on the way up. Let me turn off that parallel channel as well. Let's look at the daily chart. And so I'm looking at some overhead resistance. So I would anticipate resistance here at around 2030. And if it blows through that level, then I would definitely anticipate some strong resistance. You can see these matching highs right there, the wicks, some highs right in there, and those highs right in there. 2150 will also be another resistance level. So I wouldn't be trying to stop myself out of this position. In fact, I would actually be adding. If price gets up to 2030, I'm going to add to my short position. And then if it gets up to 2150 or somewhere in this area, I might front run that level. I would actually be adding even more, just anticipating the resistance and anticipating a reversal and at least a pullback. And the other thing is, even though if the price goes up and up and up, even though I'd be losing money to the tune of $4.72 per dollar, this is relatively small compared to my other long positions. So for example, if you look at my collateral, and I'll bring my Aave screen over here. So you want to look at your portfolio holistically. It's nice to have this little pairing where you have the LP and the short position, and those two things are like working together. My LP has about 4.5 ETH of potential long exposure, and my short position is about 4.7 short exposure. So they kind of match up with each other, and that's how they offset each other. But if you look at my other positions outside of the LP and outside of that short position, for example, my collateral on Aave. So here I have 46, almost 47 ETH. I have almost a third of a Bitcoin. So that's a lot bigger than the short position. So even though I would be losing losing money to the tune of that 4.7 ETH short, that's massively offset by this 47 ETH long, right? So I would still be making money. So that's another reason why for this short position, I just pretty much just leave it there. And if price just rips higher, fine. I'll add to my short position at 2030 and 2150. I'll add even more. But I'm still happy. Like, yeah, I'm losing money on the short, but I'm making a ton of money on all my longs. So again, just look at the portfolio holistically, not just your LP, not just your short position, but all of your positions. And that's what's so cool about our app. You connect your wallet and you can see all of those positions in one place. I can pop that up over here as well. Looks like Roman just did an update on that. So let me refresh that and you guys can see that as well. Let's bring this over. So you can connect up to 3 of your wallets, EVM and SWI as well. And it's going to show you all of your positions in one spot. So here's my perps positions. I have the short on ETH. I actually have a long position, just a little bit of a speculation here on SWI as well. It shows my lending, my borrowing positions, my spot assets, the liquidity position. We haven't added Robinhood chain to the app yet. We will we'll be doing that very soon. But this is only showing EVM liquidity positions at the moment. So it shows pretty much everything in one spot with the app. So again, just join Overseas DeFi. Community, $97 a month. You can get the portfolio tracker, the AI, all the video courses, the live Q&A session. We do that on Fridays for the Overseas DeFi community. So really a great way and not expensive, right, to learn how to do all of this stuff the right way. You can chat with me in those Q&As and, get some help directly and some support with your positions and stuff like that, and the AI as well. So there he is. What's going on, buddy? Thanks for tuning in again. If it goes too high, you could get liquidated though, right? Absolutely correct. You put those chips on the table and the price can only go so far against you before all those chips are gone, right? So if you look specifically at my position here on ETH, my margin is, I put about $2,300 in margin. And there it is. The liquidation price is $24.20 at this moment. This will change around a little bit because depending on the funding rate, I might be depleting my margin by paying the funding rate. Right now, it's a negative funding rate. So I actually am paying 0.0003% per, I believe that's an hourly. Yeah, that's an hourly rate. And so that funding rate that I am paying on the short position, that comes out of my margin. So anyway, but that's my liquidation price. 24.20 is pretty high. And again, I would be ecstatic to see ETH trading back up to 2,400. Like the little liquidation of my little $2,300 on the short position, that would be trivial compared to what I would be making on all of my long positions throughout my entire portfolio. So good question on that. I appreciate everybody tuning in. That is it for me. Remember, I do this every Tuesday. Try to do it every Tuesday, 6 p.m. Eastern. So make sure you subscribe to the channel and turn on notifications. Like the video, leave a comment down below. Thank you very much for watching. We'll see you next time.